Good morning, distinguished directors, council members, and guests. Welcome to the fourth session of Climate Governance Malaysia's Directors Masterclass Series 2025. My name is Avicenna, and I'll be MC for today's session. Today's masterclass is titled Responsible Climate Risk Management by Investors. This session aims to clarify how institutional investors assess climate-related risks, as well as present practical approaches to identify and manage unintended biases in climate frameworks. We'd like to extend our sincere appreciation to the Institute of Corporate Directors Malaysia, ICDM, for their support in making this session possible. Before we begin, please consider completing the optional pre-session survey via the QR code that is being displayed on screen. And while you're scanning the code, allow me to walk you through today's session agenda. We'll start with opening remarks by CGM Council Member Dato Johan Raslan, followed by a keynote by our main speaker, Ms. Liza Jansen, Head of Responsible Investment at Prudential. After that, there will be Fireside Chat with Liza, moderated by Dato Johan, which will contain a Q&A session to answer any burning questions you may have. With that, I would now like to invite Dato Johan to deliver the opening remarks. Please welcome.
Thank you, Avi. Ladies and gentlemen, welcome. Thank you very much for coming here to the sunniest part of Kuala Lumpur. It's really my pleasure. Oh gosh, my face. I hate that. So that picture was taken and put in one annual report of a company I was director of. I never liked it, But then because it was kind of easy, everybody took it and copied and pasted. It appears everywhere. When I think of myself, I think of my WhatsApp picture. So if you look at that picture, which is about 20 years old, that's a much better picture. That's probably some kind of greenwashing, probably. Anyway, so welcome to this. As we gather today, we find ourselves, it's very much a pivotal moment for global finance and corporate responsibility. Investors are now at the very heart of climate transition, way that investors assess price, manage climate risks, and increasingly determines not just portfolio performance, but the pace and direction of global decarbonization itself. We've seen tremendous progress recently in how the investment community incorporates climate risk into decision-making, moving from, we'll talk about this later, moving from exclusionary screening towards integrated framework, scenario analysis, and net zero alignment. And new challenges emerge all the time. I think you agree with me that this is very much on the agenda in companies, whereas really only a few years ago it was not even mentioned or thought of some kind of almost a fad. One of these issues is unintended biases within global climate models. We'll get to that with Lisa later. Today's session gives us an opportunity to explore the issues and be guided by somebody with deep expertise and practical experience in the field, Lisa Jansen, Head of Responsible Investment at Prudential. Let me just say a few words about her. She's a CFA, which is in itself, pretty cool. Speaking of one of the many people that after my accountancy exams, I thought, I'll do the CFA, no problem. I'm shit hot with exams. I got the books, opened them, thought, oh man, this is too hard. And that was it. I never did anything more with them. So I take my hat off to you, Lisa. She's been with Prudential for 5 years, Head of Responsible Investment for the past nearly 4 years. And this is a global role. But she chooses to be based in Kuala Lumpur, which in itself is pretty good. Before that, she was in PGGM, which is a Dutch asset manager managing pension monies, and the second largest pension investor or manager in the Netherlands. You can look her up on LinkedIn, which is what we all do with everybody nowadays. But let me just say that through work and through study, she has had exposure to, of course, the Netherlands and, of course, Malaysia, but also the US, kind of varied portfolio places that she has worked and studied in. The US, Hong Kong, Mexico, Saudi Arabia, and Hungary. I mean, you couldn't really make it up, I think. So I think from chatting offline, I think she's enjoyed all those places. On behalf of Climate Governance Malaysia, where I'm privileged to be a council member. I'd like to thank you all for joining us this morning and to extend sincere appreciation to Liza for sharing her insights, which will happen. I hope that this masterclass will inspire some deeper reflection on how we collectively can build a more responsible, transparent, and equitable investment system. In addition to this, in case I forget later, you can always look up what Liza said at our Global Summit back in September. It's online. I've got it on YouTube, and it was just excellent. So I do commend that to you. Okay, with this now we're going to have a quick change. Sorry, you're going to come here, Liza, and do your introductory slides. Then we're going to sit down and we're going to chit-chat. Thank you. Liza, Jansen. Thank you.
Okay, great. Okay, well, thank you for having me today. Really great to be here. So yeah, as Johan said, I'm Liza Jansen, Head of Responsible Investment at Prudential, covering it's a global role covering all of our markets, but based in Malaysia. So very close to Malaysia and have a lot more knowledge on Malaysia. So what I'm going to do with these couple of slides, I'm just going to introduce Prudential for people who don't know, also what our role is as investor. Just setting the scene, what our approach is on responsible investment, and then we'll have some more deep dive into the questions. But I thought it would be good to set the stage. So just for people who don't know Prudential, I have a life and health insurer operating across Asia and Africa right now. As you probably know, originally a UK company, so loads of history. We're now 177 years old, but we don't operate in the UK anymore. Also not in the US, that has been demerged a couple of years ago, and now solely focused on Asia and Africa. So we have lots of customers, but I focus on investments where we have 275 billion funds under management. So that's kind of my territory. And a lot of these investments are invested through our asset manager called eSpring, but we will also work with external asset managers. So we call ourselves an asset owner because we have a lot of assets that need to be invested, but we invest through asset managers. Because that's regulation in most of the countries in which we operate. So we have a quite extensive sustainability strategy, which I'll just share very quickly. It focuses on the entire business. So we have 3 pillars, basically. The first one is really focused on the insurance side of the business, because that's, of course, very important to us as well. We're focusing on things like inclusive insurance. How can we approach people that are lower income, for example, marginalized communities, and that's all first pillar. But the second pillar is completely responsible investment. So that's my area and focuses on how can we use the money that we have to generate more positive impact. And especially on climate change, how can we accelerate the energy transition through the assets that we have while still managing our assets in a responsible way and meeting our fiduciary duty, meaning that we have to act in the best interest of our policyholders. And then the third pillar really focuses on sustainable business. So we have our own business, we have our own employees, and how do we create change internally, which is incredibly important to make sure that all the other things get integrated. And we have a foundation of good governance, of course. So on responsible investment, we actually set a couple of targets, externally communicated targets, which is a good way to make sure that there's internal guidance and internal pressure to make sure that we focus on these topics. So in 2021, we pledged to become a net zero asset owner by 2050. So that's aligned to the Paris Agreement. And also in line with the Paris Agreement, we're setting decarbonization targets every 5 years. So the current decarbonization target is to reduce the emissions of our investment portfolio by 55% by 2030. So we're measuring the carbon emissions of the companies that we invest in. Part of it is attributed to us because we are owner of that company and that carbon footprint is being reduced. We also have an internal investment target on financing the transition. So we like to contribute towards actively financing companies that are doing well on the transition and that provide climate solutions. And to focus more on this, we actually have an AUM target. So we're looking for these investments and seeing how we can do more in this space. And then we have an engagement target as well. And engagement is talking to the companies in which we invest, making sure that they understand how important climate change is, that they manage climate risk. And this target is just to show how important we find it that we engage with these companies. So interestingly, I think we're one of the very few asset owners that have done this. The first two targets are actually linked to remuneration of executive management. So we have more sustainability KPIs which are linked to remuneration, but most of them are actually on responsible investment, and the first two are. So that really creates a lot of top-down pressure for the business to look at these and make sure that we meet the targets. So as an investor, we operate mostly in emerging markets. So for Prudential's interesting, I find Prudential extremely interesting because from a portfolio perspective, a global portfolio perspective, we have a lot of assets that can be invested globally, but it depends on local regulation. So for example, we have Prudential operates in Hong Kong, Singapore. These are more developed markets. All the assets that are coming in through those entities can be invested globally. And from that perspective, we're a very global investor. We invest everywhere, all different asset classes. But then we operate in a lot of emerging markets as well. And in these markets, we have to invest locally. So Prudential Malaysia, for example, for regulatory reasons, large majority of the assets need to be invested in Malaysia. We also have liabilities in local currency. So even if we didn't have the regulation, we still would have to be invested in Malaysia. And that's true for most of our markets. So Vietnam, Thailand, Philippines, everywhere we are, we mostly invest locally. So we have this quite unique perspective compared to other asset owners, that we have a very global and a very local portfolio at the same time. And that's actually what we're utilizing a lot for our responsible investment strategy. We're trying to align to global standards as much as possible, utilizing those assets we can invest globally, but then start advocating for all the needs for the markets in which we operate, because we have investment teams in those markets. We have an eSpring office usually in those markets. We have a lot of knowledge on the markets, so we know that some of the global standards just don't work in certain markets. So, for example, we joined the Net Zero Asset Owner Alliance, which is a big alliance of asset owners pledging who set the net zero target. Within that alliance, very much focusing on what does it mean to invest in these markets, and how can these markets decarbonize? And you can't just take a one-size-fits-all approach for these markets. And that's really key to our approach, and very much a differentiator compared to other asset owners. This strategy has been very successful internally, a lot of support, because it speaks to our business strategy. Because we speak a lot about the markets in which we operate. Those are our customers. These are the companies we also purchase services and products from. So it resonates very well internally. Also, a very important point up there is why we actually do responsible investment. It's part of our fiduciary duty. We have to. It's the law. So a lot of not all, but a lot of the sustainability considerations are financially material. They have a financially material impact, either directly on the company, or it's a systemic risk and therefore impacts us as an asset owner. We invest across companies, governments, listed equity, corporate bonds, everything. So even systemic risk like climate change, it's going to pop up somewhere in our portfolio. This is a risk we can't diversify away. We have to take it into account. So from a fiduciary duty perspective, we have to integrate these into our investment decisions. But now also additional regulation is coming up. A lot of regulation purely on climate change risk management. In our local markets, we have to explain how we're managing this risk. So it's not just voluntary anymore. When I started, it was voluntary. It's not anymore. But it's always been part of fiduciary duty. It's clear this risk is a financially material risk. So that was just a very small, short introduction on what Prudential is, why we're doing responsible investment, and kind of really trying to get the message across that we're both at global and local investor. We're very much at local view, which we incorporate into our RI approach. But Johan asked me to start with the key messages, which hopefully we'll end with as well. And I tried to summarize them for you. So the first one is really focusing on that fiduciary duty. We have to do this. So as an investor, we have a responsibility to talk to our companies, to manage this risk, to sometimes take decisions, make different decision on how we invest in the company if we incorporate this risk. So as the companies in which we invest, it's crucial to understand that we have to do this. It's not a voluntary thing. So if we ask questions to a company, how are you managing your risk management? It's incorporated into our decision whether or not to invest in that company and how much to invest in that company. So that makes it's financially material for us, but also for the companies in which we invest. And we are very often on the other side as well, being a listed company ourselves, and we know our investors take this into account as well. Another key message I usually share, especially here in the region, is monitor all of these market standards because they have a huge, huge impact. So the global standards, a lot of it coming from Europe, having a very, very large impact. But still, try to come up with something that works for your organization. You need to know what's happening in the rest of the world. It's going to have an impact. But if we really want to create change internally and actually want to do something, we have to focus on something that just works locally and works for that particular organization. And that's also usually easier to explain to other stakeholders, to your investors, because then it shows really thought about it and it's an approach that fits the company. So another thing, and we'll deep dive a little bit into this a bit more, be aware of unintended consequences. I'll share a little bit more about this later for our own metrics and our own targets, but setting a target is great. It usually focuses the organization, but once you set a target, it also becomes very, very important. And we all know in one metric, it's impossible always to incorporate everything. There are going to be unintentional consequences of setting certain targets and using certain metrics. Just be very, very aware of those unintentional consequences. We can talk about it. It's understandable, and at least it can be managed. But I think most importantly, and I'm not sure that Get Started it actually applies to you, but having that experience, looking at this, having an approach, looking at climate change, seeing how it impacts your organization, you have influence. Everyone is still looking on how to manage this risk, how to exactly implement it, still even on climate change, and especially true for other topics like nature and biodiversity. But once you have that experience, you can actually influence others. And that's something Prudential is doing, but I think a lot of the companies in which we invest should be doing as well. For example, regulators are also looking at how should we approach this risk. If you have experience, you can share your own experience and influence the kind of standards, the policy that's evolving in this space. And I think that's what's been one of the key messages also to Prudential. If you have a good approach that's been thought out, people are really, really interested to learn from you and take it into account. And I think that's a key way how to have influence on your stakeholders, which is not just for us, asset managers and investee companies, but also policymakers and regulators, which I think is policy engagement so important thing to do. So we'll get back to these key messages later. I will just dive into questions right now. Johan has prepared some, but also really happy to answer questions from the audience. It's going to be more like an open discussion instead of just me giving a presentation. Okay.
Okay, hi. Well, yeah, thank you very much. I thought we'd, as we discussed earlier, sort of go down a few themes, but see how it goes, right? And anybody who has any burning issues you want to raise, or questions, or even objections, please don't be shy. Right? I know you're not normally shy. Actually, I do have my first question is perhaps the most crucial of all. You've been here 3 years in Malaysia, and been around, obviously. I really want to know, do you like Malaysian food?
No, no, I love it. It's really good. Yeah, yeah. One of the benefits of being in Malaysia, of course.
Well, you've got the audience on your side already. Where do we go from there? Yeah, so, yeah, well, that out of the way, I think that's very important. So, okay, so maybe try to go through four themes and then see how it all develops. So you mentioned climate risk management by investors. How's that approach, how do investors approach it? Evolution of the approach. Yeah, I was very interested in what you said about things like ESG, et cetera, in the summit talk. And then this thing about unintended biases and how to manage them. Perhaps a bit shorter, but so just to sort of kick it off. So you know the way you manage it, you mentioned. So you've got your global, which you're part of global Prudential. You've got your local one here. Do they ever come in, let's say, conflict? Do they ever take different views on positions to take on companies?
Yeah, of course. Yeah. So we have, as a global investor, we're a listed company ourselves, so we have our own reputational risk that we need to manage. And we are constantly being compared with our European peers. Because we're originally a European company, our listing is still, major listing is still London, with the second largest one in New York. So we're still very much compared to Allianz, Aviva, the very European peers. So you notice the questions we receive from investors and the expectations that are put on us are very much in line with European views. So as a lot of previously, it has been changing now a little bit, a lot of focus has been on exclusions. So you just exclude companies from your portfolio. You just completely divest. You also lose all influence, obviously. And there's been a lot of pressure on insurers like us and asset owners like us. There have been huge campaigns from NGOs against asset owners, trying to get them to divest from these companies. But this obviously clashes very much locally. On a global portfolio, might be manageable from our perspective. We think it has a negative impact on the return that we can get, but it's not that huge. If you look at a local level, then the impact becomes very, very large. So a lot of the campaigns and everything have been focused on coal divestment. So just divest from companies that generate electricity by coal or coal mining companies, because coal, of course, is the most carbon-intensive source of electricity. You can do it on a global level. Many of our European asset owners have done so. You do this in Malaysia, you divest from the utility sector, which just doesn't work. That impact locally is so large. But apart from the fact that we have a lot of financial impact locally, we're also a client. This just doesn't work. We can't just divest from Tenaga. And it's not something we want to do. Tenaga actually has a good transition plan. This is not something that we want to do. It doesn't work. Us pulling out money, it's not going to work. So in case of, for example, the large impact it had on Tenaga, and locally here on Malaysia, we do a lot of engagement with other companies. We've been leading collaborative engagement with Tenaga. And we actually really like that transition plan. But this is one of the things where it's really clashing. But from a global perspective, and our investments come in from a global perspective, they can say, you can easily do this. And we're like, yeah, but the impact locally doesn't make sense from a fiduciary duty perspective, but especially doesn't make sense from a sustainability perspective either. We have a lot of influence with these companies. We can actually engage. We can vote. We have influence with them. Let's just use that influence and try to get them to change instead of just divest.
So what form does this engagement take? Is it meetings with the management?
Yeah. Yeah, so it depends a lot on the company itself. We do, so we have an engagement target. So there are many companies that we require our asset manager eSpring to engage. They do a deep dive into the company, And there are many forms of engagement. So they can either, it can be very basic, like sending a letter. And if the company is already doing very well, we've been engaging them for years, we just monitor, and then it's usually just written. But we have calls with management as well. We like to have preferred management to be on that call to really discuss the issues. And we can do collaborative engagement as well. So that means that there are multiple investors targeting one company for engagement. There's one lead investor, so we are, for a number of companies, we're the lead investor taking the lead on that particular engagement, but then with more asset owners and asset managers, you're engaging collaboratively with that particular company. So there are many different things you can do. It's also very local approach. So we rely a lot on the local teams, because that's actually another thing we noticed on engagement, how, especially in this part of the world, how engagement should be so much more different compared to Europe. It's just different markets, different culture, how you approach management, all of these things you kind of need to know. Also research show engagement is more effective if it's done in the language, local language, if they share the culture. So we're really trying to utilize this. Take an example, in China, you utilize WeChat a lot.
Oh, yeah.
Yeah, but we have someone who's Chinese who actually does that, because I wouldn't know. Yeah. But you need these kind of local nuances to actually have impact.
So you mentioned something about the difference in approach, say, here compared to other people. What kind of thing are you talking about?
So, for example, in Europe, a lot of companies have, very well-established investor relations teams. You just reach out to that team, there's immediately a response. Yeah. You set up a meeting. They're very, very much used to it. It's all in English. Everything's fine. If you try to do that here, it's sometimes much more challenging. You either don't get a response, so you have to find other ways, because the investor relations team are, for example, not so developed. You try to find other ways into the company, it's not always in English. So especially in countries like Vietnam, very often it's in Vietnamese, and English is not going to get you very far. So we get our local, we're going to get our local investors involved, so the local Prudential team, the local eSpring team, and have those engagements. Another thing very important for this region, two other things is actually, engagement is traditionally being done through listed equity. So you buy equities of the company because you become a shareholder, then you have influence. A lot of companies here in the region rely actually more on debt financing. And for them, talking to providers of debt is actually very, those can have a larger impact on the company because they're more reliant on them. It's not the case in Europe and the US. Through debt, it's very, very difficult to engage. But here, you can actually do quite a lot of engagement through the debt that you have of these companies. So these are the kind of differences that you do have to take into account. Just like state-owned companies, family-owned companies, much more common here in Asia than they are in Europe and the US. And it takes a very different approach if you talk to companies like that. You just have to understand where they're coming from. And all of these things have to be taken into account if you want to be successful. And I think that is something that the European and the US investors can do a better job, trying to understand the local issues, the local structures, if you really want to drive change at a company.
Yes, certainly. I think you'd find difficulty speaking to an investor relation team in most Malaysian companies that can talk about climate changes. That's probably not, but that may not be reflective of the, let's say the owner at the top of the family company, or even the board of directors. This is the ICDM is an association of directors, and I noticed that it's starting to be mentioned that board directors should engage with investors. Do you ever see that board members being asked to engage directors?
We occasionally have some board members on engagement calls, yes, as well. But we usually prefer management.
Yeah.
Yeah, because they tend to have more impact, although don't underestimate the impact of the board on the company. They have a huge impact. They can drive so much change. So actually engaging with a board member can be very useful.
Yeah.
But again, not all board members are as influential as others.
Yeah,
So,
they're probably
yeah.
not likely to show exactly the board dynamics
Yeah.
to an outsider. You know,
That's
they keep-
difficult to
yeah, you know,
understand.
yeah, okay. We've seen this phenomenon of ESG ratings. You know, I notice it quite a lot. ESG ratings look very good for some companies,
Yeah.
and yet when you look at that, surely not that. Can't be that company is is a good company from say a sustainability standpoint or a climate change standpoint. You talked in your global summit talk about the sort of the transition from ESG to sustainability.
Yep.
And ESG ratings and so on. How do you view ESG ratings? Are they still worthwhile?
So as an investor in our responsible investment strategy, we actually say be very, very careful with ESG ratings because they are very subjective. So the correlation between ESG ratings of different kind of providers is very, very low. Often the correlation on certain indicators is better. Like carbon emissions is a relatively objective measure, then the correlation is quite high. Even like board diversity, these kind of things are in itself objective. But what you're trying to do with ESG, what they're doing with ESG ratings, they take all of these indicators, and like hundreds, they apply a weighing to them, and it all adds up into one number. And that weighing, that's different for almost all data providers. They have their own weighing. They say for this company or this particular sector, E is more important than G or whatever. And that leads to that very low correlation. But then you also don't understand anymore what that number means. There's so many different indicators underlying, and it kind of creates that impression as well, oh, if I do well on climate, I can offset my really poor performance on social, which is weird as well. You can't just offset those kind of things. But within an ESG rating, you kind of can, because it's a weighted average. So if you do very well on one side, it will offset some of the poor performance on the other side. So we've always been very, very careful with ESG ratings. Look at the underlying indicators. And there we still rely on data providers, because then the data becomes a lot more reliable. But ESG ratings in itself, they usually just focus on how a company operates, so its own operations. So it doesn't really look at what a company does. And that's a transition from ESG to sustainability, where in sustainability we try to take into account what that company does. And I think this is where a lot of confusion and unhappiness has been coming from ESG ratings, is because a lot of people didn't understand that ESG just focuses on how a company operates. So companies with quite a clear negative impact on the world, so for example, tobacco companies that have negative impact on health still can have a very high ESG rating, which is because it doesn't take into account the negative impact of tobacco. It purely looks at how that company produces tobacco. And so that negative impact is not integrated. And when you switch to sustainability, that's what we try to do. We look at how the company operates, but also what it's doing, and try to incorporate that as well. And that should give more of a holistic view on the sustainability profile of that particular company. But it also means these kind of engagement discussions are much more challenging. I mean, tobacco for us, of course, an important risk. I mean, we're life and health insurer. We know the negative impacts on health. So for us, tobacco is naturally something that we don't view as very positive. So we take that view. That's incredibly important. But the same on climate change. A lot of oil and gas companies, a lot of high carbon intensive companies can still have a very high ESG ratings, which led to a lot of questions and a lot of question marks around ESG in general, responsible investment, and that hasn't really helped, I think, the conversation, because there's just a lot of confusion about what these things actually measure and how you can use it for management as well. But that being said, they still have an impact. And this is what I mean with monitor global standards, but take your own approach. We still look at our own ESG ratings because we know they are factored into investment approaches. So it is something we're looking at. It's something we see. We are having a look at how is the ESG rating of Prudential being impacted. Is there anything we can do? But at the same time, we understand all the challenges with it. So we're not necessarily using it ourselves. But yeah, they still shape a lot of investment funds.
At the bottom of some of these ratings is kind of self-rating of, the companies will say, okay, I do this, I do that, and these all get reported and then compiled, right?
Yep.
Then you get the number. So ultimately it starts from a company saying, company themselves making these things rather than somebody coming and writing about them. How do you believe the information? Do you ever go and sort of audit, or do you commission audits of?
So we do a lot of engagement with the companies, so which you get a lot more information. Engagement it's very often approached from a responsible investment strategy. It's always key because you talk to the company, you get a lot more information. But engagement has actually been around for a very, very long time. Investors have always been talking to the companies which they invest to understand the numbers better, to understand the reporting better, to make sure that indeed those numbers get audited so we can trust the numbers as well. Mm-hmm. And it's not different for sustainability. So a lot of the engagement that we actually do is done by the actual portfolio manager. So they engage on financial indicators and on sustainability, and they ask similar questions. So especially if the indicators are very important to us, we ask them to be audited, for example. And we have internally, of course, our own processes as well, making sure that the way we integrate these kind of things, that someone is looking at, that we are doing the things that we're saying that we do. So we have a lot of focus on that as well. But this is incredibly important. The data needs to be credible. And that's actually where data providers can be useful, because we invest in so many companies. They do a check as well. They check whether the data is correct. You can't always find out, but obvious mistakes they can correct for those. So that's already very, very helpful for us.
But of course, this country we're moving more towards adoption of the S1, S2 standards for reporting, and then will come fairly quicker than we know. Assurance, so-called not audit, but assurance of quite a lot of data.
Yes.
Are we heading? Do you think we're heading in the right direction? Because there are a lot of people, I must say, who, particularly in companies, who say, "God, please, we're going too fast." Are we heading in the right direction with these, with adoption of global standards on reporting? Do you think, in this country?
I think so, but you're asking a biased person. So yes, well, because we need that data. We need to have more information on. I think dual materiality. I know in the US it's a little bit different right now, but dual materiality is very, very important. We need to know how climate change is going to impact the company, but also the impact of the company on climate change and what we're trying to do to manage this. Because for us, so climate change is a systemic risk. We know it is going to have impact on individual companies. We need to know that impact, because there is a way how to manage that risk by just, making different investment decisions per company. But it's also a systemic risk. We know it's going to impact everyone. We just need to limit the impacts of climate change, because that overall, for our total portfolio, that's by far the best outcome. If we just transition and try to minimize the physical impacts of climate change. So that impact of companies on climate change and how they're managing that and their contribution is incredibly important from that systemic risk perspective. So a lot of questions I always get is the distinction between risks and opportunities, because that was in TCFD always one of the key distinctions. To me, it's all it's all kind of the same, because opportunities for us means we actively invest in climate solutions, we actively invest in companies that are doing well on a transition, but overall, in that way, we try to accelerate the energy transition, which will minimize the risk of physical impact of climate change, and minimize that, well, try to manage that systemic risk. So in the end, to me, it's all very much risk management, while at the same time, there are good opportunities to being captured, but it's all the same. It's just different sides of the same coin. You're always eventually trying to manage overall risk, because for everyone, the best outcome by far is transition. We know this, even though it might be, some countries might be in denial, but you know, there's so much scientific evidence. Transitioning, the cost of transitioning is so much lower than the cost of physical impact of climate change, and that's just physics. There's nothing we can do about that. We're already noticing the changing climate. So, yeah, eventually we need to manage that risk.
Yeah, we are here. Okay, now, you know, when we are online, right, we have the chat box and the Q&A box, and then most of the questions are all anonymous. And unfortunately, we don't have that here. You know, so I don't have a chat box to look up. You've got to have questions from the floor, things you want to say. Please don't hesitate. Right? If you want to do anonymous, you can say, "I refuse to tell you my name." Okay? But I already know your name's Johan, so you know, don't try. Liza, I'm suddenly very, very nervous standing here. I was calm and relaxed, right? And then my chairman from Climate Governance Malaysia walked in and sat in the front row here. So Dr. Gary's here now. Oh my God, you know, everything was looking very good until he stepped in. Yeah, so, I'm shaking here. So anything, please, you know, just speak. You've got a question.
Yes, I have a question. I'm Emily Koch. I net at Hong Leong Financial Group. So we do have an insurance arm. I mean, as an insurer, the finance emissions are the real challenge,
Yeah.
right? I mean, I hear you do a lot of engagement. What I would like to know is, how often do you do this engagement? Are they standard across the board? In harder to abate companies, right, do you have any special treatment? Are there any special tools that you use?
Yep.
And how large is your team? My second question is also related to the question that I've just raised, which is the lack of standardized data and metrics. So across different asset classes and markets, right, we don't have the consistency. So how do you overcome that? Again, are there tools? What are the tools that you use? And also, how do you handle greenwashing? I mean, how do you manage that aspect? Thank you.
Okay, so for engagement, we take a very local and deep dive approach. We don't believe in mass engagement. So that's, some investors do. So they send out thousands of letters to all of these companies, just the same letter, which is a very easy way to get very high engagement numbers. Could be useful for like first raising awareness for like new topics. So I'm not saying it doesn't have any place, but we prefer more targeted engagement. So we are the asset owner. We invest through asset managers. So technically the asset manager has to do the engagement. So as an asset owner, we set the requirements on engagement. We're saying we have an engagement target. You have to engage on these and these topics. If for climate change, we actually become more specific on what kind of questions that need to be incorporated. But we always allow for differentiation between the companies and between sectors, because your engagement with a hard-to-abate sector is going to be very, very different compared to engagement with easier, for companies for which it's easier to transition. So when eSpring engages, the team does a deep dive on the company, really looks into its sustainability report, all the external communication, making sure that it's that they understand what the company is trying to do. They're also trying to use, but this is difficult, they're trying to use metrics that are more applicable for that company, because the metrics we use as an investor are not always that useful for the company itself. Because, to take an example, for a utility company, your carbon emissions per kilowatt of generated electricity is a good indicator of how well that company is doing on climate change. But from a purely investor perspective, and we invest across so many different sectors, carbon emissions per kilowatt hour electricity generated is not a very useful metric. We can't aggregate this up to a portfolio level. So what we do is we look at carbon emissions per revenue, $1 million of revenue, to make all the different companies comparable. But on a sector level, like on an individual company level, this doesn't really mean much to that particular company. So there's a difference on how we have to measure carbon footprint and then how we engage. So these kind of things we incorporate, and we really expect that full understanding from our asset manager when they start these engagements. It's also something we expect from our own investors if they are engaging, because we don't like being engaged by a tick box exercise and you just notice the investor going through all different questions and then, okay, that was his buy. That's not something we like. So we have specific questions on hard to abate. They're very local as well. We kind of know what kind of solutions can work for certain hard to abate companies because we've seen these kind of solutions with other companies. We try to use those kind of examples to really help the conversation. And then it becomes more of a conversation. Because just answering questions you really want to get the company to think about what they can do and how they can manage. It just helps if you show you have interest in the company, you understand what they're trying to do, even though as an investor you can't fully understand, of course. But still, I think that works a lot better. So I think that was the first part of your question, but the second part, I'm not sure I answered that one. The greenwashing. So from our perspective or the company's perspective?
From your perspective, but how do you detect greenwashing?
Okay.
The tools that you're using.
So we don't really have a tool on greenwashing, to be honest. I don't think anything exists right now to detect greenwashing. So again, engagement is useful. Talk to the company, see whether it's credible what they're saying. And we have sector specialists, so they kind of know what's feasible and what's not. You can't always know, of course, but sometimes certain things are like so overstated, and we know there are certain things you can't say anymore. You can't be an oil and gas company and claim to be really. You can make claims on transition, but you can't make a claim to be green, and we've seen those cases, right? You just can't use that language anymore. And those kind of things are known, and we are sharing this with the company as well, because again, it's a financially material risk. We have seen court cases against these companies, and they lose, and it's costing them a lot of money. So be careful in the language that they use. But we don't really have a tool for this. It's scanning as we usually do, reading their sustainability reports, seeing what kind of claims they make, and make sure that they're credible. Now, AI might be useful for this, though, to scan a lot more reports and everything much more efficiently than we could do.
Well, AI probably wrote the report anyway, right? AI probably wrote the report anyway, and now you use AI to scan the reports. It's all the kind of battle of AIs going on. What happens, Lisa, when something, there's let's say some sort of a scandal of sorts, so I don't want to name names, but when companies are sort of hit by a sanction from, let's say, US, and it becomes big news in the sustainability sphere, et cetera, or maybe there's a emission spill or something, something that affects the environment, or very often nowadays it's more on the workers' rights and human rights side. What happens then? Do you just dump the stock?
It very much depends on the situation. So as Prudential, we have our own risk tolerance, and because if we invest in these companies with large controversies, it looks bad on us, and we might hit some headlines because we're investing in those. So we have our own risk appetite and see whether we want to, indeed, if it's really bad, divest from the entire company, have a Prudential policy we're going to divest. That's like the last resort that we take. We prefer to start engaging with the company first to understand it better. But then at the same, so that's a Prudential wide policy, which would be initiated by responsible investment. But at the same time, we have our portfolio managers. And they, of course, make the financial decision on whether to invest in certain companies. So actually, not that long ago, we had a sanctioned company in our portfolio in one particular market, and the portfolio manager decided to divest. So we thought the risk was too high. Not much upside from investing in this company anymore, and the portfolio manager decided to divest. So even though Prudential didn't decide as a group, but that in that particular market, we decided to divest. So it has a material impact. These kind of scandals have a material impact on how we view the company, the valuation, whether that we actually think is still a good investment.
See, Gary's got the mic, so.
Okay, so I've been outed by the moderator, so there's no point trying to hide my identity. But thanks very much, Liza, for agreeing to be with us today. My question is with respect to specific projects, which can be very large. And oftentimes, a company that may not be in a very climate-friendly or environment-friendly, sustainably friendly sector attempts to undertake some kind of transition project. What's the view of Prudential with respect to some of these projects that are aimed at a transition but are not yet green? For example, I mean, the EU, and this is related to the second part that I want to raise, which is about taxonomies and how useful they are. Or is it better do you find it better to actually use your own corporate policy to actually run a taxonomy? But do you view some of these, for example, natural gas project, moving away from coal to gas? Do you still see that as something that is part of a legitimate transition, or do you draw a line and say no, as long as it's not biogas, which is completely climate neutral, then you'll only have something to do with it thereafter. But if it's still fossil, even though it's so half the emissions of coal, it's still something that you would consider part of a transition. Just like to get your view on that.
So as Prudential, we actually have our own approach on what we call financing the transition. So we launched that, we published that approach last September. No, the year before, 2024. But we've been using it internally for longer. And this is the internal investment target I was referencing to, where we have an AUM target, and we try to have a number of investments into companies that align to this framework, our own internal framework of new investments. So we're not just counting stuff that we already have in the portfolio just because it's in the portfolio, but it has to be an intentionally made investment towards the transition. The reason that we came up with our own framework is we saw two challenges with the current frameworks in the market. And again, most of the frameworks were coming from Europe. First of all, too much of a focus of things that are purely green. And that's the EU taxonomy. Just focuses on things that are already green. Now that's 8% of the market. We can't invest in just 8% of the market. It doesn't make sense from a financial perspective. It doesn't make sense from a sustainability perspective as well. So we needed to incorporate what we call transition finance. So exactly the thing you're talking about. Companies that are currently carbon intensive, but have a transition plan and trying to decarbonize. And we think we should be supporting those companies because those are actually going to make a huge difference. We need those companies to transition. But there wasn't really a good market standard out there, some taxonomy or something that we could follow and we could easily implement. So we came up with our own rules. Then secondly, another challenge that we had with the frameworks in the market is that it was a one-size-fits-all approach. It didn't account for emerging markets. So basically, everyone was saying you can have different decarbonization pathways for sectors, but not for countries. So we were saying an Indonesian utility company needs to decarbonize at the same rate as a German utility company, otherwise it's not credible. Now, obviously, Indonesia has very, very different challenges compared to Germany, but it also, of course, applies to Malaysia. You can't just expect the same thing. is not aligned to the Paris Agreement either. The Paris Agreement was a success because we incorporated a common but differentiated responsibilities principle in the Paris Agreement, which says some countries have higher responsibility to act because they had more historical emissions, and also have more ability to act because they have more access to financing, and they should be taking the lead. So different net zero targets between countries are allowed under the Paris Agreement. That's why India can have a net zero target by 2070 and China by 2060, where the EU has 2050. As financial industry, we have failed to incorporate that principle into our responsible investment frameworks. So we are saying a company that doesn't have a net zero target by 2050, even though the country in which it operates doesn't have one, is not considered credible. It's quite very surprising to me. So as I said before, we rely on these kind of data providers. We can't even get the data. If a company has a net zero target by 2060, and I ask my data provider, does this company has a net zero target? It tells me no. Because the data provider already says it's later than 2050, it's not a credible target, so it doesn't have a target. But an Indian company that has a net zero target by 2060 is 10 years ahead of its government. It's incredibly ambitious. We should be financing these companies. And yet, in almost all frameworks, they're just seen as not credible. So we allow, that's the second challenge in our financing transition framework that we're trying to address. We're strongly advocating that we should be supporting these companies. You have to take these local circumstances into account. So that also means in certain countries, coal to gas, yes, it can be transition. It depends on the local circumstances. It depends on carbon lock-in. You don't want to, build too much new infrastructure that's going to be there for the next 50 years and we can't move away from it anymore. All of these kind of things you need to take into account. But this is so important that we focus on this.
Thank you. Now I've got a question here.
Okay, Johan, you can do
You're first, then Johan.
Okay.
Okay. So your name?
Zalina. Thank you, Liza. So thank you, Dr. Gary, for setting the question for me to follow up, because I exactly have the question on transition finance. I had decarbonization for hibiscus petroleum, one of the dirty industry that you support. Thank you so much. We engage East Springs a lot because you're one of our investors, and I think I appreciate that. So the question directly to you is, in my engagement with the investors, there's always been that term, credible transition plan, right? And in my layman's term, credible transition plan means as a company, you have not just the plan, you know that for these projects, you plan it, it's in your pipeline, you have budget for it, you know what the emission reduction is going to be, or whatever that mitigation plans are. So that's how I would term credible transition plan. And I'm happy to say that we have reduced by 46%, right? Our target is 50% by 2030, we have reduced 46%. And as mentioned, that's because we were lucky to find a few projects that far in between that managed to reduce that much. It's not always the case. So the question to you more on how do you define credible transition plan from investor perspective? Number two, can you share examples of successful transition finance? Because I'm still trying now with all the banks that we've been talking to, and it's quite still very high level. And what is transition finance from your perspective, specifically oil and gas?
So we indeed focus a lot on that, credible transition plans. Not just a net zero target, because those are relatively easy to set. Because it's so far in the future, there have been a lot of targets that have not been managed very well. But there are a lot of aspects we would like to see in a credible transition plan, and that's how the company is doing risk management, how its governance is set up, and what we ideally like to see are CapEx plans. How are they going to invest are they actually allocating capital towards these transition investments? Now, that CapEx plans is something we're always engaging on, but not a lot of companies currently have them. But it is something that's gaining a lot more traction also with other investors. So there's going to be more focus on this. It's move beyond just setting the net zero target, just doing your governance. We really want to see tangible actions that the company is planning to take, and then we're of course also looking at carbon emissions and seeing whether it's actually resulting into reduced carbon emissions. So we're looking at both, but for us the switch to credible transition plans meant that we are switching from just purely backward-looking data, where you look at the historical carbon emissions of a company, and trying to do forward-looking assessments, and then plans come into consideration. So we have a sectoral engagement approach anyway, and a sectoral approach towards these decarbonization plans. So you can't expect the same investments from different companies in different sectors. But additionally, we try to see, of course, what's feasible within the country. And eSpring Malaysia is hopefully engaging with you, and they understand better than our head office, for example, from eSpring in Singapore, what needs to be done, particularly for that particular company. So we look a lot at peers as well. We think that's actually one of the more useful things to do, because if you have a peer that is doing well, it usually serves as an example for other companies in the same sector. So that's how we're trying to differentiate between sectors and between countries. And I really hope you notice this in our engagement approach, that we really try to take that local understanding. If you then invest we invest in mostly funds, because as an asset owner, we have to go through asset managers. So for our own financing and transition strategy, we're actively looking for asset managers that take this approach. But we do realize it's very, very challenging, because certain funds, most funds, are global funds. And then to have a country view is very, very challenging in so many different countries. But we have seen some great examples, actually. So we invest, but this is an infrastructure equity fund, in the Brookfield Catalytic Transition Fund. So what they have done is they take global sectoral decarbonization pathways. They have so many internal researchers, really to get really jealous of them. So much knowledge, and they translated those global sectoral decarbonization targets into country sectoral decarbonization targets. And then they're assessing the companies based against that particular decarbonization pathway. Still, it's a more high-level approach. As a company, you have much more knowledge, of course, than from this top-down approach. But still, that allows us to incorporate those specific country approaches into how we invest. So if Malaysian company is not transitioning as quickly as a Dutch company, that's okay. We understand that it's a very different starting point, different responsibility, different access to financing, and that's how we try to take that into account. But I'm not saying it's easy. You need a lot of data, you need a lot of knowledge on locally, and that makes it challenging, and especially if you have these kind of global funds. But we see more examples, because investors know this is not the way forward. Just investing in just green, or just investing in developed markets, it's not going to work from a sustainability or financial perspective. Just to give an example on investment funds, and that's some research I've done myself already years ago, and what I've been sharing a lot. If you look at a listed equity fund, global, and it has anything in the name, sustainable, climate, ESG, any of these kind of terms, the allocation towards emerging markets is half compared to the broad universe. Why? Because emerging markets are not doing so well on sustainability. They tend to be more carbon intensive, they don't have as much governance in place. All of these things, that just leads to an underweighing of emerging markets. Exactly because of the one-size-fits-all approach. Because we have certain standards, coming from developed markets, we apply them to emerging markets, and then we're all surprised that emerging markets don't live up to those standards. Well, they shouldn't have. It's not aligned to the Paris Agreement. We need some flexibility. It's just not working. 90% of the increase in carbon emissions projected, it's coming from emerging markets. They're currently responsible for 60% of global carbon emissions. We have to finance that transition. Otherwise, we can't get to global net zero. So we need to find a way to support those companies in that transition instead of divestment, because it's not going to work. So.
Thank you, Zaina. Now, Johan.
Okay. Yes, yeah. I'm also a bit nervous because my lecturer, Dr. Gary, is here. So anyway, on that note, if I could ask your views about the data center boom that we are going through. In the West, they're just pushing it out to developing countries. Singapore has issued a moratorium about 6 years ago. And what a lot of these companies do is that they come and they throw money to NGOs, right, with the promise of planting trees and lots of money. And so the NGOs get a bit conflicted. So if you could get your views on that, this boom.
Yeah, so this is another thing that we're trying to raise awareness for. Why it's so much more difficult to decarbonize the utility sector in emerging markets compared to developed markets. So very often we talk about hard to abate sectors. Very interestingly, there's actually no definition of what's hard to abate. I tried to look it up. For a lot of the investors in Europe, utility sector is not considered hard to abate because there is already solar and wind and everything. Here, in a lot of emerging markets, you have population growth, economic growth, and now the boom from AI, data centers, which is going to lead to a huge increase in electricity demand, which makes the utility sector a hard-to-abate sector in certain markets here. Yeah, water as well. So we incorporate this, and especially trying to communicate this to more developed markets as well. You all use AI, but you don't want a data center, so they're moving in towards these kind of countries, and you have to allow them to, they need to, their electricity demand is going to increase. You have to take that into account when you do the assessment of how quickly you can decarbonize. So there are some could be some positive benefits to these data centers boom, because a lot of these companies themselves have decarbonization targets and are demanding renewable energy for these data centers. They're even setting up some of their own utility plants trying to provide electricity for that. So it could lower the cost of renewable electricity in these countries, but still, just meeting the electricity demand through renewable energy only is actually quite challenging for a lot of markets. So if you look, for example, at Vietnam, the switch to renewable electricity is actually a global example. They're doing so well. How much renewable electricity that they're adding each year, it's really incredible. And yet, even the International Energy Agency is saying they need to be adding coal until 2030 because the boom in electricity growth is just so large, they don't know how else to solve it. So these kind of things, it needs to be taken into account when you assess a Vietnamese company and how they're doing, that particular utility company. But yeah, data centers is one of the drivers currently, and a lot of demand is coming from the markets that don't want the data centers themselves, or don't have the space for it anymore. But it is something we really need to take into account.
Okay. Okay, we've talked about engaging with companies. What about engaging with policymakers?
Yep.
And then from there, I mean, in our country, how engageable are policymakers? Are they open to it, or?
So for us, we've been engaging, just like with companies, we've been engaging with policymakers for a long time. We operate in these countries for a long time. We're a local asset owner. We engage on regulatory issues, but also how do you develop capital markets? We need capital markets to be able to invest, to get a good return so we can offer interesting products to our clients. So we've been engaging for a long time. with policymakers and regulators in the countries in which we operate. And we do the same thing on responsible investment and sustainability. Again, it's a systemic risk. As an investor, I believe we can accelerate the energy transition. We can use the money that we have. We can't start it. And we need an enabling environment where it's a collective action problem. Everyone needs to act. And very importantly, the government and policymakers as well. And they can do a lot through the regulation and the incentives that they put in place. So I think policy engagement is crucial. We do it a lot. We have local government relations teams, so we focus a lot on policy engagement, but I think companies can do this as well, especially collaboratively if you don't want to be seen as lobbying, which could have a negative reputational risk. Collaboratively, you can, as a sector, start engaging with the government, with policymakers, with regulators, seeing what's needed to actually have that enabling environment that allows you to transition. Just similar to us, we need that enabling environment as well to actually make changes in our portfolio. So I think policy engagement is incredibly, incredibly important. Also, again, coming back to the systemic risk, the only way to manage systemic risk is to get all actors involved and have them transition. So you can't just focus on your own. It needs to be collective action. And not just on a transition, also on the physical risks of impact. It's actually a good example in Thailand where there was a couple of years flooding, and that was a real estate company, and you could see from satellite images the real estate itself still intact, great, had prepared itself very well. You couldn't reach it anymore because the rest around it was completely flooded. There was no infrastructure anymore. So you can prepare yourself, but there's only to a certain extent. At some point, you do need that collective action. You need governments. You need to have the protection of the entire region and not just your own asset. Because if it's not accessible anymore, you can't use it anymore. So I think that's a very crucial point as well. It's not just about doing good. It's just about your own survival as well.
May I ask then, because interestingly now we've seen that sort of climate impacts are beginning to I guess recently the surge in extreme weather events, things like Vietnam getting 1.7 meters of rain in 24 hours. Mm-hmm. It's like, how do you even think about defending against something like that? Yeah. That's 2 meters of rain, almost 2 meters of rain. Yeah. What we hear from investors is that there's always money for mitigation, but not so much for adaptation. No. So is there we've got one of the strange projects in Malaysia, the Smart Tunnel, which is one of the very rare adaptation projects that actually is paid for itself and is now actually making money. But have you come across any other examples of either co-beneficial mitigation adaptation type projects, yep. Or even purely adaptation ones that actually have a revenue stream and that can be financed? Yeah.
So we actually incorporate adaptation into our financing the transition framework, but we don't see many pure adaptation investments. I think there are two challenges with that. First of all, the investment gap is just huge. But it has a lot of different reasons. It's government responsibility. A lot of it is the government responsibility, and governments don't always have the funding to actually do this. But there's also just behavioral biases. We have this optimism bias that actually gets us through the day, I think. But it also means that we're very bad in incorporating and actually managing these type of forward-looking risks. But then I also think, at least with the asset managers that we speak with, there's a lack of understanding of what adaptation investments are. So yes, a lot of it is a responsibility for the government, like building dikes or whatever. But there are still governments still rely a lot on private companies as well to actually do those kind of things. So there are adaptation investments you can do that are financially viable. So even like early warning systems, for example, that's from a pure financial perspective, great investments. You can do these type of investments, or more regenerative agriculture, making it more drought resistant. Again, those kind of things are also a risk management tool, and these kind of things you can invest in. So I think that's something we're advocating for. Look a little bit broader than just government responsibility on adaptation. You'll see there are interesting investment opportunities. I also think there's going to be a lot of investments going to come from companies themselves trying to manage their own physical risk. And that's something as an investor we can start raising awareness for. So the companies are trying to get them to prepare for the physical risks of impact, but also general insurance companies, so not us, but general insurers, of course, they can incorporate how well a company is preparing for the physical impacts of climate change. We have seen some companies, insurers in Hong Kong, that integrate this into the risk premium for companies, and that obviously will spur a lot of investment, because then there's a financial incentive to invest in these adaptation measures, which then again is good for us because it will drive some financial return we can invest in. But yeah, the challenge for government, at least, there is a lot. The return on investment for adaptation investments is huge, but not everything is a financial return. A lot of it is avoided cost, and we as an investor need financial return. So certain things we just can't do, and we need to rely on governments, and then policy engagement comes in again.
We're coming sort of to the end of our time. I just want to just open up one more subject. It's about the riches of nature and biodiversity in this country, and basically all part of the world, and how the value can be sort of unlocked. There's obviously the obvious way of unlocking it, which is cut it all down and leave it all bare, which
we should be trying to avoid.
Certain states in our country, have sort of have gone to town on that. So what's the future of that, do you think?
So nature and biodiversity is something that's very high on the agenda of investors, but also regulators. Everyone is looking at it. It's an incredibly challenging topic. Same actually as adaptation, but it's, I think, more challenging than the climate adaptation, because it's for two reasons. Nature, we're using nature and biodiversity interchangeably, those terms, but they're different. Biodiversity is one of the topics within nature. But there's so many different topics within nature, and all need their own approach. Also, just water is pollution. Even climate change has a huge impact on nature. So you have so many different topics: invasive species, species extinction. There's not going to be one metric that we can measure the impact of companies on nature, like we have for climate change, where you can use carbon emissions. So that already makes it incredibly challenging. But then also the very local nature of the nature problem. It's local biodiversity is obviously very, very important. Every country, every region will need its own approach on how to conserve its nature. Certain solutions in one country won't work in another country. It's just a very different ecosystem, and you have to manage these. So that's making it incredibly difficult. However, I think what we can do is similar to adaptation. We can start raising awareness. Please look beyond just your normal things you think about when you do nature investments. So everyone is talking about mangrove protection, these kind of forestry, these kind of things don't necessarily lead to the financial return that we need. So we can't really invest in those. But there are other topics you can do as well. Proper water management, circular economy, sustainable agriculture. All of these things have such large benefits on nature, and those are the things we can finance. I'm not saying everything has a good return, but you can find investments that have a decent return, and we can actually invest in those. So that's the approach that we are currently taking. Try to get more awareness on what it actually means to do nature. Just protecting mangroves, it's not going to be enough. Really, companies have to reduce their impacts on nature and try to change that from a negative impact to either neutral or a positive impact. And I think for, especially on the, again, we come always from a very emerging markets view. Again, we need to be aware of these kind of biases with the frameworks that we use. So even, very interesting example actually. Not sure anyone has actually looked at the definition of a forest. So I've done that. So, yeah. But it's, the definition of forest includes plantations that are used for wood, and wood-like products are included in the definition of a forest. Specifically, Christmas trees are called out as saying a Christmas tree plantation is a forest. Agricultural plantations are not a forest. So you have some reforestation in the numbers for the UK, for example, but some of these are non-native single species plantations, but are used for wood. So it's seen as a forest in the number. You would do the same here with palm oil. It's seen as deforestation. Obviously, palm is also a tree. There's not really a difference between the impact on nature. Both are non-native single species plantations, which we know have a negative impact on nature. And yet sometimes it's counted as reforestation, and other times it's counted as deforestation. And those kind of things are just very unfair. And we have to account for this. But it's all historical. This definition everyone is using from 1946, set up by the UN, it obviously has those kind of biases that were prevalent then. And we're very reluctant to change the definition because then you can't monitor over time anymore. But the same thing is true for deforestation rates. Everyone focusing on deforestation rates. Historical deforestation is ignored. The forest share is in a lot of these markets higher than in developed markets, but the deforestation rate as well. And it's, as with many sustainability topics, very much related to stage of economic development. A lot of developed markets, as you said, have been able to monetize their natural resources by cutting it down. We need to start incorporating in the conversation, how can we allow a lot of other countries to monetize their natural resources as well, but without cutting it down. And we need to find a mechanism for that. And then biodiversity credits, even though we know there are challenges on greenwashing and everything, at the moment it's the best example we have, but we need to find a solution for that. And these kind of conversations we need to be having, because too much is just focused on engaging Indonesia and engaging Malaysia without completely ignoring what had happened before in Europe, for example. Talking about my own country, Netherlands, not doing well on engagement, yet all the Dutch investors are engaging in Asia, and they're not engaging in Netherlands on nature.
Mm-hmm. Thank you. Now, we've reached the end of our time, or reaching it. So I'd just like to ask you, Liza, what are your final thoughts? You don't have to follow this, but I've put up your key messages, just so people remember. But what are your final thoughts that you want to leave us with at the end of this session?
So it's again coming back to that local approach. You understand much better what Malaysia needs, what's a practical way forward, and what works for the company. If you have investors that are serious about this, they want to know, they want to learn. And a lot of investors are serious about this. They have to manage the risk, it's their fiduciary duty, but they also need to act in the best interest of the policyholders, so they really want to understand. If you have an approach that works for your organization, for the country in which you operate, the sector in which you operate, I think you can convince a lot of stakeholders why this is the best approach. Not just investors, but also regulators and policymakers. And they are struggling with the exact same thing. They see all of these global frameworks emerging. They want to move forward. They try to align. We're also calling for standardization because that's easier. So there's a lot of pressure to just adopt whatever is out there, but they also know it might not always work. They want to hear from local companies on what can work, not just saying no, but saying, we've seen these global standards, this is why it's not working for us, this is how we're going to deviate from it, but this is what we're doing instead, and why we think that this is a credible way forward. And that messaging is something we've been doing for last couple of years, and I think it has worked very well, and it's been resonating very well. And I think that's a much more practical way forward instead of just trying to align to global standards that doesn't work for you. So, and I think the only way how to convince your internal stakeholders as well, because it's still so much seen as just something that's coming from Europe, basically, from other outsiders that are telling you what to do. But if you show you have an understanding of the challenges and what is driving people, that will help you get the message across much better and create some change, some actual change, and not just reporting and accounting.
Well, thank you very much. That was a brilliant session for us. Thank you. I haven't finished yet. You've given us a session laced with, I think, a passion, pragmatism, and practicality, and that's exactly what we need here. I'd like to thank you. I also want to thank Emily, Zalina, Johan, and of course my friend Dr. Gary for the questions. And thanks to ICDM for the use of your lovely premises. Thank you very much. And last but not least, Liza Jansen, CFA and Malaysian food lover. Thank you. We hope to see you again soon.
Thank you.